Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. In today's video, I'm going to be giving some promotions, some demotions in regards to weightings inside my portfolio using the portfolio organizing tool Passiv. It's a free tool to use, so if you like what you see, I'll put a link in the description below. But more specifically, I've recently made a swap in my portfolio. I changed out one fund for another. But doing that, I've also been reflecting on performance of some of the funds, and based on some of those performances, I want to reward some of those funds for exceeding my expectations. Now, none of these funds have disappointed me. There are funds that have just met my expectations, but the ones that have really punched through and exceeded those expectations, I want to reward. So let's go through that right now. So for those who don't know, this is what the Passiv home page looks like. This is the landing page where you can set up different portfolio types. And as you can see here, I have my wife's spousal RSP and then my TFSA. The spousal RSP, I'm not going to spend too much time here. It's a very boring portfolio. It just has HYLD.U in it, and it just drips. It compounds away month after month after month. The one portfolio that I wanted to specifically touch on was my TFSA. I just got some dividends, so what it basically does, again, for those who aren't sure, you'll set targets. And when you set targets, if you have some cash lying around, it basically tells you exactly what to buy. It won't tell you what to sell, but it'll just tell you what to buy to get in line with your weightings. So as we move down in the portfolio, you can see these are the targets that I initially set for this portfolio probably back 6 to 8 months ago. So we got some 17 percenters, some 25%, well, one 25 percenter and one 7%. And then this is what it's actually at right now. Now you can see like funds like BKCL have 0% as a target. You'll see HMAX has 0% as a target, UMAX 0% as a target, ENCL 0% as a target. These are Canadian CoveredCall ETFs. My plan with these funds is to basically let them, I'm no longer going to buy them inside my TFSA. I plan to basically restock those funds once I get a taxable account. Those are going to be the funds that I'm going to use to offset, supplement costs in 2025. If you want a big breakdown of my plan short term, kind of 3 years out, with what I call beating the Vancouver housing market by exiting home ownership to get into a house rental where my costs actually don't change, I'll put it'll be one of my last portfolio unveil videos where it'll say something like $186,000 portfolio with $1,800 in monthly income. So you can check that out for yourself. Maybe I'll put like a little thumbnail on the screen or something I guess this way, just to give you a cue as to what to look for with the big grand plan. But in short, those funds in of themselves, nothing's going to happen. I just have a little waiting. These will diminish and I will no longer buy them inside my TFSA. But in my taxable account, absolutely I will. I'll be an absolute yield hog when it comes to my taxable account. But this portfolio in particular is more of a 75% middle of the road strategy. I invest pretty much in all of the all-in-one funds. So these are ETFs that invest in other ETFs like BMAX, EQCL, HDIF, HDIV, HYLD. So again, these are funds that invest in other underlying ETFs, mostly sector-specific funds like financials and energy and industrials and the like. But I do have one sector fund that I'm going to keep in here that's not an all-in-one, which is HTAE. It is a specific, highly concentrated tech CoveredCall ETF, and that gets the largest weighting of all at 25%. So, like I said at the top of the video, what kinds of changes am I looking to make? Well, recently I actually swapped out USCL for EQCL. Now, EQCL has been on my radar for a long time. The only reason I hesitated to get into it was it's basically made up of indexes like the S&P 500, the NASDAQ 100, the TSX 60 here in Canada, and then it had an emerging markets fund and a developed markets fund. But those two funds, developed markets and emerging markets, were not CoveredCall ETF based. They were sort of these growth ETFs where the dividends would get reinvested back into themselves, but nonetheless, they were not CoveredCall funds. But with the launch or the rebranding of Horizons ETFs to Global X, they finally launched some emerging markets and developed markets CoveredCall ETFs, and now EQCL is fully 100% CoveredCall ETF base, which means the yield, which is, as of making this video, maybe around 11.8%, probably most likely jumps up past 14%. At least that is my speculation. We won't know until July 2024. Or actually, I should say, we'll know probably late June once distributions are declared. But they won't hit our brokerage accounts until early July. Okay, so EQCL, that's been the biggest swap that I've made. But now let's get into the demotions, promotions, and the logic behind why I'm going to be changing out some of these targets. So for starters, I'm happy with all of these all-in-one funds. They are performing exactly as I would hope for them to perform, which is first and foremost, as a CoveredCall ETF income investor myself, I look for funds that typically have the ability to grow a little bit price appreciation wise. If possible, I always have to say that if possible, I would like them to grow a little bit. But some of them have really exceeded my expectations. So let's go in and edit the weightings here, the target. So right now I'm at 0%. There's nothing I can move around. I have BKCL at 0%, ENCL at 0, because those are not my targets. Like, I will sell them off at some point in time. So as I buy other funds, these funds will diminish in their weighting because obviously I'm no longer contributing to it anymore. Okay, so let's go to the first all-in-one fund, BMAX. What am I doing with BMAX? It has the lowest weighting out of all my funds here. What do you guys think? Demotion, promotion? It's getting a promotion. BMAX is a steady buoy in the portfolio. When the market's down, this thing stays stable, and when the market's going up, BMAX has a way of going up as well. It is a fund that invests in a bunch of Brompton CoveredCall ETFs. It has about 33% leverage, which is the highest of any fund that I know of in Canada. And I mean, if you get into it right now, it probably has a 9.5% yield. For me, my average yield is, I think, in the low 10%, but that's okay. I'm happy with anything over 10%. So right now, that promotion, BMAX, I'm giving you a 10% weighting. Well earned. Yeah, so much I can talk about with BMAX, but we'll keep moving right along. So you'll see I'm at negative 3%. So as we head down the list here, we're nothing to speak about ENCL. Let's go to EQCL. Just swapped it out. What am I doing with EQCL? For now, EQCL is just going to stay as is. I've had this in my portfolio for, as of making this video, just a couple of days. So I'm not going to change anything with it. It's just going to stay at 17%. Time will tell whether I give it a raise, give it take some percentage points away from it, but for now it's going to stay at 17%. HDIV has performed exactly as expected, but it has not exceeded my expectations like, say, a BMAX has. So because there are other funds on this list that we still need to look at, I'm going to be giving HDIV a 10% weighting in line with BMAX. Now, HDIV is also a leveraged fund at 25%. It invests in harvest-based underlying sector CoveredCall ETFs. Still a good fund. I like it, but funds like BMAX have exceeded those expectations, and And also it's kind of nice just to have like a 10% weight instead of 7 and 17, kind of these oddball numbers. So HDIV moves down to 10%, which means I still have 4% left over to use. So the next fund on our list is HDIV. What are we going to give this? Thumbs up, thumbs down. We're giving HDIV a raise. HDIV gets a 2% raise, going up to 19%. Why is this? Hamilton ETFs have really knocked it out of the park with HDIV, which invests in basically multi-sector CoveredCall ETFs. They're all in-house, meaning their own sector funds are what's in HDIV. Half of them are Canadian, half of them are American, roughly speaking. But their distributions have increased. There has not been one single cut ever since this fund came out, I believe, in early 2021. And it continues to be just a really solid distribution grower inside of my portfolio. So HDIV gets a raise. Next up is HDAE. This is meant to be the rocket fuel of this portfolio. This is the growth component, whereas the other 75%, kind of middle of the road, they pretty much invest in everything across Canada, the States, well, North America in general, and globally as well. But this specifically only invests in American tech companies. So for now, HTAE has been going gangbusters since I bought it back in, I want to say October 2023. I think I might be up something like 18 or 20% just price-wise on it alone. And I have like an average yield of 11.3% on it. Whereas if you get into it now, I think it's maybe 9.5%. So I do expect Harvest to bump up some of their, a tech fund like this. A lot of the other fund managers have been doing that ever since I've owned HTAE. So I wouldn't be surprised if in the nearest future, albeit that is pure speculation, that they bump up their distribution for HTAE, and then my average yield probably goes up a little bit even higher. But for now, it stays the same. And last on the list with the all-in-ones is HYLD, which I will be jacking up to 19%, which means I have no more percentage target space left over. So 19%, why is this? HYLD is one of the first funds I've ever invested in. I've gone through the growing pains with HYLD, especially when it was paying out 14 cents a share last year in April. Then they bumped it down, or they had to cut it down to 12 cents 12 cents for every unit that was paid out for their distributions. But since then, HYLD has been on a absolute tear. They have swapped out a bunch of funds by Global X, and they were essentially invested in third-party funds, but they've internalized everything. Now everything inside HYLD is handled by Hamilton ETFs, which means they were able to cut fees. We've recently just seen an interest rate cut. So here in Canada, who knows if the states fall. I mean, eventually these interest rates will come down somewhat. I'm not going to say that they're going to go rock bottom, but they'll come down somewhat. And then that means the leverage costs will undoubtedly go lower. Able to keep up with more distribution increases, which this fund has been doing ever since the beginning of 2024. Four distribution raises, just like HDIV. These two in combination with Hamilton have absolutely exceeded expectations. I've gotten price appreciation from it. Total return has done really well in that regard. And I'm just very happy with these two funds. Could I increase their weightings inside my portfolio? Absolutely. But this is not like I change every week. As I've said, I haven't changed this in roughly 6 to 8 months as far as the weightings are concerned. So I think for the raises that I gave, they were well deserved. I know that, you know, a lot of people are invested in HDIV. Again, HDIV has performed exactly as I've expected. I have an over 10% yield, which this channel focuses on and I focus on personally. And I get a little bit of price appreciation from HDIV. The only difference is these other funds have absolutely blown away my expectations. So HDIV, you could very well get a raise in time, but it'll just, hey, it just depends on how the fund performs. So what do you guys think of these changes that I've made to the portfolio? I know they're pretty light in scope, but I thought it'd be fun just to go through some logic as to why you might change weightings inside your portfolio. So let me know in the comments below, and hit all the buttons of like and subscribe variety, and I'll see you all in the next video.